Recently, you could have summarized our strategic view as think about what you did over the last decade and do the opposite. But how should we think now as we enter 2023? Let's start with the epicenter of weakness last year, bonds. We believe that inflation will be structurally higher over the coming years owing to deglobalization and decarbonisation. We'll still get cycles in inflation, but we don't expect central banks to return to the zero rate policies of the 2010s. Thus, we can't assume that bonds will always be negatively correlated with equities. However, with the repricing of yields last year and the risk of recession this coming year, we think that bonds could offer an attractive source of yield for portfolios. Commodities performed well in the first half of 2022, but have since given back most of those gains. Nonetheless, with geopolitical tensions running high, we continue to believe that commodities and commodity-related exposures can provide an important source of diversification for portfolios. But what about equities, where markets have rebounded from the lows of last year? Regional views are stronger than outright direction. We're starting to differentiate more within equities, as regions outside the US offer more compelling valuations. US profit margins, after a prolonged period of strong expansion, are at record levels, but cost pressures in the US are now making themselves apparent at a time when revenue growth is slowing. The rest of the world looks more interesting. China is likely to accelerate quite strongly out of lockdown, and the financial sectors in Europe and Japan benefit from a move away from zero or even negative yields. Finally, a word on overall risk levels. While rate expectations are now more realistic, and we expect interest rate volatility to stabilise, we expect liquidity to remain tight in the next few months. This will continue to put pressure on equity valuations. Combined with the risk of recession, we believe that more pro-cyclical positions need to be balanced with offsetting positions, such as lower allocations to US equities. In that sense, it's still the case that we're inverting the 2010s playbook.